Somewhere in a data center you'll never see, a piece of software is quietly running calculations on more money than the entire economy of every country on Earth. Except two, it's not a bank. You've probably never used it. Most people have never even heard its name. But this system and the company that built it touches your retirement fund, the stock in your 401k, the company you work for, and possibly the mortgage on your house. Not because it stole that influence, because quietly, over 3 decades, the world handed it over. This is the story of BlackRock, the largest money manager on the planet, and the strange, mostly invisible way it became one of the most powerful financial forces in modern history, without most of the world ever noticing. Let's start with a number, because it genuinely doesn't feel real the first time you hear it. Site index equals 9-1. As of mid-2026, BlackRock manages $15.3 trillion. Site index equals 15-1. That figure alone is larger than the entire economy of every country on Earth, except the United States and China. Site, not the company's own money. Client money, pension funds, government reserves, university endowments, your own retirement account. If you've ever put money into an index fund, because there's a good chance BlackRock is quietly managing part of it, even if you've never heard the name. Here's how it got that big. BlackRock wasn't founded by old money bankers. It started in 1988 in a single room with 8 people in a very specific origin story. Founder Larry Fink had personally overseen a bond trading disaster at his previous firm that lost close to $100 million, a mistake caused, in large part, by nobody being able to properly measure the risk they were carrying. So Fink built a company obsessed with one idea. What if you could actually see risk before it exploded? That obsession became 2 things. First, an asset management business that grew, decade after decade, by offering something simple, low-cost, diversified index funds that quietly outperform most actively managed portfolios over time. Everyday investors piled in. Pension funds piled in. And every dollar that came in gave BlackRock a little more scale. And every bit of scale let it undercut competitors on fees even further. It became a snowball that never stopped rolling. Site index equals 8-1. In 2021, BlackRock became the first asset manager in history to cross $10 trillion in assets. It hasn't slowed down since. Site, but the money itself is only half the story. The other half is something most people have never heard of. In the late 1980s, alongside the asset management business, Fink's team built an internal tool to help manage risk across their own portfolios. They called it Aladdin, short for Asset Liability, Debt, and Derivative Investment Network. At first, it was just a tool for BlackRock's own use. Then, in 1999, they started licensing it out. And what happened next is the part of the story most people have never heard. Site index equals 15-1. Other financial institutions, including direct competitors of BlackRock, started paying to use Aladdin's risk modeling software for their own portfolios. Site index equals 15-1. Pension funds, insurance companies. Even Vanguard, one of BlackRock's biggest rivals, uses it. Site index equals 22-1. By the end of 2025, Aladdin was providing risk analytics for roughly $25 trillion in assets, about 7-8% of the entire global financial system. Site. Sit with that for a second. One piece of software, built by one company, is quietly involved in assessing risk for a meaningful slice of all the money on Earth. Not because governments mandated it, not because of some secret deal, because it was simply good enough and trusted enough that even BlackRock's competitors decided it was worth paying for. That's not a conspiracy. That's what happens when a tool becomes infrastructure. The same way half the internet quietly runs on services from 2 or 3 tech giants nobody thinks about while scrolling their phone. But infrastructure at this scale comes with a different kind of power. And this is where the story gets genuinely worth understanding, not through rumor, but through how the financial system actually works. Because BlackRock doesn't just manage money passively. When you buy shares in a company through a BlackRock index fund, BlackRock, as a shareholder of record, often gets a vote on that company's behalf at shareholder meetings on things like board elections and executive pay. Multiply that by millions of investors across thousands of companies, and you get something unusual in modern capitalism. One asset manager holding meaningful voting power in a huge share of the world's largest public companies, not because it wants to run them, but because indexing by design means owning a little bit of almost everything. That's not a secret. It's public record, and it's been reported on and debated by economists, regulators, and journalists for years. Some worry it concentrates too much quiet influence in too few hands. Others argue it's simply the mathematical result of how index investing works, and that BlackRock, in practice, rarely uses that voting power to intervene directly in how companies are run. Both things could be true at once. And that tension between this is just how modern investing works, and should any single company really have this much quiet leverage, is the real debate, not some hidden cabal. A structural question about scale. Here's what's easy to miss in all of this. BlackRock doesn't own most of the trillions it manages. It manages them the same way a fund manager holds your retirement account without that money being theirs. But not owning it and not influencing it are two very different things. And in 2026, that influence keeps expanding into new territory. Site index equals 9-1. BlackRock's Bitcoin ETF has grown to roughly $45 to $47 billion in assets, becoming one of the fastest growing investment products in history/site, a sign the company isn't just managing yesterday's assets. It's positioning itself at the center of tomorrow's, from digital assets to what the industry calls tokenization, turning real-world things like real estate and bonds into tradable digital tokens. Site index equals 13-1. The company now operates in more than 100 countries with roughly 25,400 employees/site, a footprint that means decisions made inside BlackRock ripple through markets on nearly every continent, almost simultaneously. None of this makes BlackRock some secret puppet master pulling strings behind closed doors. What it makes it is something arguably more interesting and more worth understanding. A company that grew so large, so gradually, doing something so unglamorous. Index funds risk software, back-office infrastructure that most of the world never noticed as becoming this important. There was no single dramatic moment, no headline that announced BlackRock now quietly touches a meaningful share of the global financial system. It just happened, one client, one fund, one basis point fee advantage at a time, until one day, the numbers were simply too large to ignore. Maybe that's the real story here. Not a hidden hand pulling strings from the shadows, but something almost more unsettling in its ordinariness. How much power can accumulate quietly, legally, and gradually, simply because the system rewards scale, and nobody was watching close enough to ask when large became systemically unavoidable. You don't have to believe in a conspiracy to find that worth paying attention to. If this made you look at your own retirement account a little differently, you already know what to do.